Hello, welcome back to another video. It's been a while since I uploaded. So in today's video, I'll be covering my high conviction stock that I feel is currently at risk. So for reference, this is my entire portfolio. I made some changes to it, which I'll be covering in today's video as well. So for the stock that I'll be covering today is ASML. ASML is my second largest holding in my entire portfolio. It's currently, I believe, around 8% of my portfolio. And this stock is up around 6% year to date, currently trading at a 25 times of earnings. So for ASML, here are some of the bull theses for the company, of course. So you have the AI revolution, which will increase litho intensity, which increases the complexity of all these chips, which will increase the demand for your ASML machines as well as the higher quality ones. And besides that, ASML has an increasing install base. So when more fabs are being built up, it leads to more machines, of course, for ASML, which leads to highly recurring revenue going into the business every single year, because all these machines, they last for a very long time. So for ASML, of course, you have the bull thesis here. And of course, you have comments like this as well, which says, "Hi Guan, I respect that you come out with content every day, but I disagree with ASML's narrative. If China will be able to come out with their own lithography machines, the revenue will be cut to zero. Hypothetical, if we consider, if machines successfully created, how much will it cost? Are success rates comparable to ASML? Will companies be willing to use the new machine and spend so much money to basically use the new machine that doesn't guarantee good results? How long will it take to develop the machine to make it more efficient so that it is at the same level of efficiency as ASML? I know that there are chances this can happen. I still think it won't happen in the next 3 to 5 years, I guess. So, of course, it is all a wild guess at this point. I don't think anyone is able to guess. For the Chinese people, later I'll be talking about it. What they tend to do is they tend to hide information until the time is right. So for ASML, what you need to understand when it comes to your AI China risk is that in China, a lot of the firms there are spending a lot of money on R&D. So for example, Huawei, they spent 25 billion USD last year on R&D. ASML, on the other hand, is spending only about $4 billion. Of course, not all the 25 billion is spent on lithography and the development of EUV, but I'm sure there was a substantial amount of that 25 billion that was actually put into lithography tools. So if you're to look at China as well as their past history and their success, of course people can say it's propaganda, but what you need to understand is that China is amazing at copying. So you had Tesla coming out with their cars, and then BYD was originally a battery provider. They saw what happened with Tesla, and then they replicated it. They made it a lot better, a lot more efficient, and they're selling the cars at so much cheaper prices, which led to Tesla undercutting their price as well. So besides the car industry, of course, that is just an example. You have other companies in the semiconductor space as well. So for example, SMIC is a Chinese company. They were lagging behind another company, a US company called Global Foundries. For many, many years, they were a few notes behind. But recently, they've caught up to them and they've surpassed them already. So SMIC, although it is still levels below TSMC, it has caught up to a lot of your different wafer companies in the entire world, despite starting not too long ago. So for Chinese, although they are not innovators, they are very good at copying. So that is my worry when it comes to ASML and their lithography machines. So for China, they are also spending billions and billions and billions of dollars on all these AI chips and products. So if you're to look at last year's spending, for example, China spent about $50 billion on new chip fabs. If you're to contrast this to America, America spent only about $22 billion. So the Chinese spent about double what the Americans spent. So when you have a company that is literally funding the R&D for all these different companies, it's different from when it's just a company versus another company's competition. It is literally now the whole government, the whole Chinese government, funding all these companies to compete against your American as well as your European firms. So there are two scenarios, of course. Let me frame it this way. So scenario number one is that nothing happens to ASML. ASML goes to the moon. In that case, I don't lose anything. Maybe I lose gains, but it doesn't really count as losing money. Secondly, if China creates their own machines, what will happen is the Chinese will stop buying machines from ASML, or at least they will cut it. So you can see that 27% dropping to maybe around 10%. And besides that, there will be a competitor to ASML already, which will disrupt the narrative that they are a monopoly. So you will see the multiple contract very quickly. So in that case, my downside risk is massive. But of course, if I trim my position, then I will minimize my downside risk, which is what I'm looking at today when it comes to ASML. So all this is to reduce downside risk rather than to maximize my gains. ASML is a quality business, of course, but it is impossible for you to forecast when exactly the Chinese will be able to come out with the machines. And for your Chinese people, they are very good at hiding things. So for example, this DeepSeek fiasco, it came out at such a good timing. It came out literally after Trump was elected. So the Chinese people, what they tend to do is they will create a technology. They'll create it at so much cheaper prices, at the same levels of efficiency or maybe even higher. And what they will do is they will hide it until the time is right before they release it. So this only compounds to the worry that I have for ASML, which is why I'm considering trimming my position soon when the time is right. So for ASML, it's a risky position and people are understating the downside risk potential of the company. I'm still holding, but I might trim the position when the time is right, when the valuation is a lot more sound. I think the company is maybe slightly undervalued today. I believe it deserves to trade at a 30 times earnings, which is where I'll probably trim my position. And for now, I'll be waiting this one out. Hopefully it gets to the price so that I can consider trimming my position. As for the next company that I'll be covering this stock is Meta. So I removed Meta from my entire portfolio. I initially trimmed a small stake, but I decided to basically sell out my entire Meta position. It wasn't very significant. It was a small position in my entire portfolio. So Meta is currently trading at a 27 times earnings at around $765 a share. So for Meta, it is another risky position that I sold. Meta is probably the riskiest Max 6 that I see out there, although it is the fastest growing, of course. Your capex spending is going through the roof, so they're spending so much money if you're to compare it to their operating cash flow. So next year, the company is projected to spend $100 billion, and they have $100 billion of operating cash flow this year. So that leaves shareholders with almost zero cash flows, which is my worry with the company. And besides that, they are trying to turn into Amazon without the actual use case for it. So at least Amazon, you have the AWS portion. But for Meta, all this infrastructure that they're trying to build up will only be able to help them in their family of apps, but they don't have a business model like AWS, which has so much scale. But for me, this is when I get a bit cautious with all the companies that I own. So when the companies applies more leverage and when the capital allocation is not sound anymore. So for example, Meta, they recently said that they'll be raising debt and raising equity as well. So they'll be diluting shareholders to raise more money for all this capex infrastructure. So they're planning to spend $100 billion next year and they don't have the cash position to back it up. And that's why they're trying to raise debt, which is my worry, of course. Besides that, Mark Zuckerberg is spending billions and billions and billions of dollars to bring in talent. He's spending $300 million on talents, which is quite crazy. I'm sure you guys know the history with Mark Zuckerberg and capital allocation. So for Meta, because of this, I decided to sell out my position. So next portion, I'll be talking about the markets now. So the markets today is down around 0.67%. It is currently down around 1% from all-time highs. So the markets are getting a bit frothy, so you're seeing specs coming up almost every other day. So for example, this guy is Shamif. So he's coming up with a new spec again. He came out with a lot of different specs back in the day. So he came out with specs on Open Door, Clover Health, Virgin Galactic, and all of them are down massively since the heights. And besides the specs, we could also see a surge in your IPOs as well. So we're seeing a lot of IPOs coming up in the recent days. So there's been your Figma IPO, your CoreWeaves, and so on, all these different companies coming out with their IPOs, which is getting a bit too speculative. People are piling money into IPOs, which is not healthy for the market. So you're seeing growth stocks today down massively. So you're seeing this company called VKTX. It's a pharma company. They reported something related to their products and they're down 43%. And you're seeing companies like Duolingo down 7%, IonQ down 7%, Hims and Hers down 6%, Open Door down 6%. SoFi down 5% as well. So the markets are at all-time highs right now, and there are two things saving the market today. So the first one is that Trump is saving the market with his stimulus money, and there's sort of like a Trump put at a certain level. So I'm sure we saw what happened in the tariff dip. Trump, he came out and then he saved the market. And for Trump, he measures his entire political performance to the actual stock market returns as well. Besides that, the Fed is also sort of like saving the market. So the markets are now pricing in more and more rate cuts. When your Fed start to cut rates, it will only increase the liquidity to the market, especially if your economy is still strong. So there's a counter argument to this as well, which is that if all this good news is already priced in, then there really isn't anything much to look out for in terms of the market, which is why we could see a slow and gradual decline over the next few months, especially if the market's up around 30% since the April lows already. So this is what I'm doing, of course. I generally ignore all this noise. I'm waiting for companies to add into when the valuation is right. So I'm waiting for companies like Visa, like Copart, like FICO. FICO is an interesting one that I've been looking at. And besides that, there are some other companies in my consideration as well, including Otis, Adobe, and all these different other highly predictable businesses like Equifax. So I'll be waiting out and hopefully the market has a substantial drawdown so that I can add to all these positions. Last portion, I'll be covering some questions left in the comments. So the first one, it says, perhaps some ideas I find interesting include overlooked sectors in this bull market and potential bargain and high quality companies, best companies in less talked about stock exchanges like Singapore, other countries in Asia, Switzerland, and so on. So let me talk about the most overlooked sector in the bull market. It's simple, it's your healthcare industry. So the healthcare insurance industry has been hammered over the past few months. We're finally getting to see some form of recovery after Warren Buffett bought into United Health. I still think United Health is cheap today. You're basically adding at Warren Buffett's original entry price, and it is also around my cost price at this current stage. So if you're looking for outsized returns over the next few years, I think the healthcare industry is providing a decent opportunity today. As for best companies and less talked about stock exchanges, in Singapore for example, I think the banks are great. The REITs are great as well if you're looking for dividend income. Of course, if you're looking for capital gains, then the banks are the ones that you should look out for over here. Banks are expensive today, but for Singapore, we're a bit different from the United States. The rates are down massively already in Singapore, so there should be limited downside risk in terms of the earnings of all these different banks going forward. The next question it says, I think a stock that was recently depressed is AMAT. Do you think it presents a decent opportunity? So for AMAT, it is a company in your wafer fab equipment portion. For AMAT, my problem with the business is it doesn't have a significant market share in any one of the different steps. So for example, you have ASML that is part of lithography. It is a leader in lithography. And then you have Lam Research, which is, I believe, in the etching portion. But for AMAT, they have a lot of different branches. They are not focused on one single branch. And that is my problem with the business. It is sort of like a jack of all trades, master of none. So although AMAT looks cheap today, I wouldn't be adding into this one. I hope you guys have found this one useful and invest. See you.